Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy Meta shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Cue the slide. Meta stock is currently a clear buy. My price target is between $650 and $870 for an average of $760 per share. This means I believe the shares deserve an upside of more than 31% from the current price. This doesn't mean you should buy shares expecting a quick price jump. It just means it has a pretty huge margin of safety. Because of this, if things go just fine for the company, the stock should still deliver beautiful returns. And if things go as well as can be expected and you bought shares, you will have a newly found respect for Mark or favorite android, Zuckerberg. But the stock has already gone up so much, you say? Relative to what? The stock is just a reflection, so we better take a look at the actual thing, the company. But first, let me plug in a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Meta is a titan in the digital advertising space, with the vast majority of its revenue coming from ads in its Facebook, Instagram, and Messenger apps. While the user base is already quite massive and has limited potential for growth, the company is successfully improving its monetization. And as you can imagine, the company is fully invested in developing its own AI capabilities and integrating them into its apps, which will improve the user experience, maximize engagement, and in turn, increase how much money the company makes. Meta is of course still working on the metaverse, but its potential seems to be far into the future. What is a reality today is that the company is doing pretty well selling its virtual reality headsets, which are arguably better value than most of its competitors. Hardware is still a small portion of the company's revenue, but it has quite a bit of potential, and it is nice to see Meta make money outside of advertising. Let's take a look back now. In the past 10 years, Meta's average annual growth was 32.9% for revenue and 37.9% for earnings. You cannot overstate how absolutely impressive these numbers are. In 10 years, the company increased its revenue 17-fold. And yes, margins also expanded, which explains earnings growing faster than revenue, of course. So yeah, the stock increased 5-fold since its October 2022 bottom. So what? The stock returned 22.6% per year in the last decade. High, but it's still much lower than the growth of both revenue and earnings. You know what that means? The stock has become cheaper, all while the company has become much larger and with a much more secure future. Or is it? If valuation becomes cheaper, does that mean that the future is not so promising now? Nope. For the coming 3 years, analysts expect the company's average annual growth to be 14.1% for revenue and 21.6% for earnings. These numbers are certainly below the historical average, but it's not slow by any means. It's just that past growth was incredibly fast. Keep in mind, revenue has increased so much in the past 10 years that the same gain in billions of dollars now is a much lower percentage growth. For the coming 3 years, Meta is expected to grow its revenue by $20 billion per year. Now that's an increased amount it only surpassed previously in 2021. So 14% per year is pretty impressive for a company this size. Let's see now what the valuation multiples look like. Revenue multiples are in line with where they've been on average for the past 10 years. But earnings multiples, the PE ratio, is relatively low. This is because the company has grown its bottom line more than its revenue. And given its expected future growth, the stock has a PEG ratio of just 1.1. In the long term, the stock share price follows earnings, and as with other large, fast-growing companies, a PEG ratio below 1.5 can be considered cheap. In Meta's case, 1.1, quite the discount. So it could easily be the case that in the next few years, the stock share price will increase more than earnings, so that the PEG ratio would reach at least 1.5. In fact, I would be quite surprised if it didn't. But hey, let's play it safe. Here's where the margin of safety comes into play. Let's assume that the market hates the company for whatever reason, and so the PEG ratio stays where it is. In that case, the share price will simply follow earnings, going up by just 21% per year. Really sad, isn't it? But don't worry, as long as inflation stays below 21%, you should be fine. Long story short, Meta is one of the most attractive stocks I've covered so far in these videos. If you haven't already, I recommend you check out the other ones, and let me know if you agree with my analysis. If you found this video only mildly upsetting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.